Welcome back. Newgen Software recently reported their Q4 numbers. The company saw the net profit surge nearly 22%. Margins expanded. The top line growth was close to about 14%, but that is lower than the 20% run rate that the company has been enjoying. In fact, Q4 was a 14% revenue growth, Q3 was 18%, and prior to that, the company's top line growth used to be close to about 20%, in fact, even higher than that. Virender, Jeet, CEO of Newgen Software, is now with us on the show. And just to put it in context, numbers came out on Friday during market hours. Virender, thank you very much for joining in. First, if you could talk about your top line growth. There seems to be a bit of a slowdown, 14.5% in Q4. What led to the weakness compared to prior quarters' historical growth rates? What can you guide in FY26? Can you maintain a 20% sort of a run rate or do better?
Good morning, and thank you for having me out. We have constantly grown at 20% for many years. Almost from 2013, it has been the trajectory apart from a couple of years. So there's, just to look at in the near future, there's no reason why we should not be able to maintain that. Having said that, looking at what has happened over last 8 quarters, also I think last year we had grown at almost 40% on Q4. I think it was a very heavy base. For the year, we did grow at 20%, which is in line with what our expectation is. We did expect to really grow by a few more percentages, but I think we had some amount of deal slippages and other things, which normally happens in the business. We closed a good year. In fact, as you rightly said, overall we grew at 20%. Our margins expanded. We had 40% growth on license, which is actually determinant to our future growth because the downstream revenue kicks in. And also we had a phenomenal 62 deal wins and the new logos, not only the deals from existing accounts, but especially from the new ones. And I think it was broad-based. And US fired. We did 20% growth out there. APAC fired in a big way. I think it has been healthy. What has happened is, as we are slightly increasing the number, the lopsidedness of revenue growth, which used to be happening, the Q4 and Q3 used to be almost around 60-65% of our business, has now moderated to around 55% of our business, which is, I think this phenomena will continue. We may have higher growth quarters in Q1, Q2, because relatively the numbers of Q1 and Q2 are lower. And Q3, Q4 may not be at the same percentage point, but at an annual level, we'll continue to maintain the growth momentum.
Okay, so you're saying that 20% growth run rate should continue FY26 onwards, as you did in FY25. The Q4 moderation in the top line was on account of a higher base and certain deal slippages, which are normal. It's not to do with the macro uncertainty that we're seeing. Is that correct?
Yeah, absolutely. I think there's nothing, as of now, we don't see any uncertainty in the business or nothing is coming up on the radar.
Virender, good morning. Thank you for joining in. Now that you're saying your FY26 will also continue to grow at 20%, but what about your other businesses, right? Because the banking vertical growth slowed to 10%. Your bookings for the full year grew at only 10%. In FY24, they were up 23%. What is the current situation that you are witnessing on the ground? I know you mentioned that you are not seeing any uncertainties as of now, but are you seeing any delays in spending, delays in decision making, considering all the uncertainties that are prevailing around the globe right now?
The way we see our business, we are pretty diversified. This is one thing very unique to us. If you look at our businesses are quite evenly spread around India, Middle East, Africa, US, and APAC. So a single territory pain or a kind of an uncertainty we don't see the impact that drastically at other companies do. The other thing is also it's diversified across 3 verticals now. Though banking is a larger part of that, but also the insurance and government are becoming sizable. And then if you look at the client concentrations are very, very low. I think it's quite spread. We do business with almost 500 clients and nothing is very materially big. We still are a kind of a relatively smaller company. And typically our deals are more tactical and strategic. They're not really large strategic deals for the clients where they could have an impact of non-decision making. We still, they're championed around a cause which is very urgent for an enterprise. And we have seen both an upturn where we are servicing growth or we are servicing optimization or cost. We have relevant use cases in the market. I don't see any challenges as of now. But having said that, right now the levels of uncertainty in the market are very, very different, which nobody has seen, and we don't know how the whole market will shape. Right now, we don't see those things coming to us, but I think we'll have to wait and watch.
Okay, your deal bookings are, I think, at 1,664 crore for the full year. That's a growth of 10%. And this is lower than the 20% or 20% plus growth that you had in the prior quarter. What's the reason for that? And will this not make achieving that 20% growth challenging for you in the subsequent year?
Yeah, I think this is a good indicator, but not the only indicator. Most of our, the way we look at our business at the beginning of the year, almost 70% of our business comes from the contracts which is either in renewal stages or which has been already booked, which we call business in control. We are roughly at a business in control number of 1,250 crores, which is almost 20% up than last year. And then we do have to get new deals and new logos and new license wins this year, which is not going to be significantly different than what we have done last year. So while the order book of a previous year is an indicator, but it's not the only indicator. More the outcome of this year will determine about the sales which happens in this year and the license revenue we realize in that year. Our Q1, Q2, Q3 order books were leaner. You're absolutely right. But Q4, our order book on a year-on-year grew by almost 27%. So I think there's a change in that trajectory also. And we think in this year, we should be able to build the businesses and realize the revenue on that front.
Okay. US, your investments in US seem to be yielding results now. I think your US revenue growth was about 39%. You added 10 new logos in US across various sectors, banking, healthcare, insurance segments. When will that, even the deal wins were fairly strong. What is the outlook on US, the kind of growth? How much will it contribute? What is the growth that you anticipate in FY26? And when will the deal wins, one in US, flow through into your top line? When will they start getting executed?
You're absolutely right. I think we have been investing for a very, very long time, and it has been a hard work. And I think we have built a successful customer base of around 70 customers in US now. And last quarter, you're absolutely right, was a good quarter for us. We had more than 10 wins, and these wins are typically in larger accounts. So we have pivoted from smaller accounts in smaller banks and insurance to larger entities. A lot of our deals, do the revenue starts flowing in 1 year to 2 years. That's the time frame, and the deal gets almost consumed in that kind of a thing. But since our downstream revenues from these deals also are about renewals, expansion of licenses and those things, they will continue to grow as accounts with us. Last quarter, from the number point in terms of the number of deals, has been the first quarter we have. I think we'll have to wait and watch for a few more quarters to see how much of strong base and trend we have established. But surely our investments in insurance vertical and health, which we started around 12, 13 months back, have started yielding results. Now we have got successful wins in both the areas. And banking, we keep on, again, grinding and getting few more deals out there. So if all three fire, then we'll always keep on repeating such performance. But I think we'll have to wait and watch how permanent it is this. We think the US should lead the future growth of the company. So predominantly, I think we expect that in next 2-3 years, US becomes the larger market share where we come. But I think it's work in progress, and we'll have to
How much would US contribute?
You see, generally what I think right now, the US is roughly around 22-24.5% of our revenue. But while as globally the spend for our kind of areas, US is around 60% of that. And right now our sizes are small, but as our size becomes more close to a larger company, the US should be in the same range of almost contributing 50% of our revenue.
All right, Virender, we'll hold you to these numbers. There are still a lot more questions to ask you, but running out of time. Thank you so much for joining us today. Wish you good luck for the rest of the year as well. There is a management there on Newgen Software, confident that the US could become the primary contributor to their revenue in the next 2 to 3 years. Take a short break. The management of JBM Auto joins us on the other side. Stay tuned.